Welcome and thank you for joining me for today's educational class. My name is Joseph Budd and I'm a certified financial planner and managing partner with Budd Wealth Management, helping you navigate the road ahead for what's next. We have developed and refined a process over the last 20 years to work with families that aspire to a work optional lifestyle. We hope to put all the pieces of the financial puzzle together for our clients. Connect with us on LinkedIn and Facebook, where we post interesting personal finance content and invitations to future events like this presentation on a regular basis. Also visit us at buddwealth.com. You will all receive a copy of the recording from today's session in a follow-up email. Maintaining perspective in uncertain times. Thank you for taking time out of your schedule to attend our event. We get insights on consumer behavior, which means the way we act, think, and make decisions from an institution that you've probably heard of, the Massachusetts Institute of Technology, MIT. Within MIT is the Age Lab, where researchers study the way we think, act, and make decisions. And actually, for purposes of our talk today, they actually examine mistakes we may be prone to make based on our reactions to crises. This presentation is about putting things in perspective so that we can make better, more informed decisions. Today, the data that we share with you will spotlight that a lot of times investors will panic during a crisis, leading to less than optimal decisions. The MIT Age Lab was created in 1999 to invent new ideas and creatively translate technologies into practical solutions that improve people's health and enable them to do things throughout their lifespan. Based within MIT's School of Engineering, the MIT Age Lab applies consumer-centered systems, thinking to understand the challenges and opportunities of longevity and emerging generational lifestyles to catalyze innovation across business markets. Here are the three areas we'll cover today: stress, anxiety, and crisis, instinctual behavior, and maintaining perspective. Let's begin with our analysis of the first area: stress, anxiety, and crises. Stress, anything that disrupts homeostasis. Fear, clear and present danger. Anxiety, anticipation of a clear and present danger, whether real or not. And a crisis, a stage in a sequence of events at which the trend of all future events depends. When we look at this picture, we can see that there's no shortage of crises that have happened in our lifetimes, whether it's a financial crisis, a energy crisis, a banking crisis, a real estate crisis, a foreign affairs crisis, world conflict, you name it, there's a flavor to go around. When we look at the life cycle of an issue, it starts with a pre-crisis normal planning, followed by investigation, event mobilization, escalating media attention, multiple actors engage, interest group mobilization, there's a preliminary assessment and an allocation of blame, whether it be on a system versus an individual, followed by congressional hearings, symbolic actions like a commission, a policy change, and reports are issued and we return to our new equilibrium. Sound familiar? The accumulation of crises can cause us to feel three ways. Meaninglessness. The system is meaningless. Normallessness. There are no more rules. They're not followed by anyone. Powerlessness. There's nothing we can do to make a difference. As a result, we tend to seek information that confirms a negative view that we may already have. This includes those ideas clients might hold about the markets. Now that we understand that, let's move on to behavioral outcomes. Here's a graph of the Google search trends for the term CNBC and their correlation to the performance of the S&P 500. See when searches for CNBC were the highest in red? On October 1st, 2008, Congress passed a $700 billion bank bailout. That's when CNBC searches peaked. On September 29th, 2008, the Dow Jones Industrial Average fell 777 points, and the headline read, "Dow has worst day ever." Who remembers what happened the next day? The market was up 485 points. Who remembers reading the headline, "Dow has best day ever"? Nobody does, because it didn't happen. Or if it did, you read it on page D8, right? Because when it bleeds, it leads is a popular slogan in the media. Well, the positive headline didn't get covered. In fact, as the S&P 500 recovered, that's the blue line, many of us searched less on Google for CNBC, the red line. This graph conveys that we need to be mindful of our tendency to invest attention in the negative, which can cause us to miss certain investment opportunities. The MIT Age Lab tells us that after we focus our attention on the negative, many are tempted to panic. They sell stocks and buy safer investments. The blue mountain chart is the S&P 500 index. We took select headlines that maybe you remember. Lehman Brothers or Washington Mutual bankruptcy. TARP was signed. The unemployment rate was 10.2%. The flash crash, interest rate hikes, and so on. Given the negative tone of these headlines, there's always a reason not to invest, isn't there? And what do many investors do as a result of hearing these headlines? They pulled out of stocks. And by the way, what's the market doing during that time? Recovering. When we look at this, ambiguity is a negative. If it's not clear, it must be bad. These are the same steps that we just went through. We may be going through a crisis right now. Just turn on the business news or world news. I'm sure we can find one. But because of this level of uncertainty and uncertainty of an outcome, it causes us to have apprehension and anxiety. The third thing the MIT Age Lab tells us is that we're likely going to do during a period of anxiety is become very risk averse. Psychologists call this loss aversion. We're more concerned about not losing our money than making money. I'll give you an example of a concept called the pain of loss. We are more upset about losing $20 than we are happy finding $20. The concept says that if you walk down the street and you pick up a $20 bill and you put it in your pocket, you're pretty happy. I think you know I'm a pretty lucky guy or gal. 10 minutes later, I go and I pull the $20 out of my pocket and I can't find it. The fact that I can't find it will bother me 2 to 3 times as much as the enjoyment I got when I found it in the first place, despite the fact that I am economically no better or worse off when I started walking down the street. Let me ask you a question about this graph. Which is there more of on this chart, red or green? Green, right? A lot or a little? A lot. These bars are the individual market returns each and every year since 1926. There are 69 positive green bars and 25 red ones. So why is it that this one bar in 2008, right here, can dominate our thinking about investing? It's because of the pain of loss that we discussed earlier. That last drop was more than 50%, and that's what's on our minds today. And that's maybe why we may be over allocated to positions that may be less risk averse. When we're in a crisis, it's easy to forget the long-term positive market statistics. To take this concept a bit further, what was the risk or what was the opportunity where these markets earned more than 20% versus when they lost more than 20%? In 35 of those years, you would have earned more than 20%. And in only 6 years, would you have lost more than 20%. The chance that an upper middle class couple age 65 today lives to 95 is 43%, according to the Society of Actuaries. By 2029, the odds of that 65-year-old reaching 95 jumps to 51%. Why is this important? It's because our portfolio should be allocated to give our assets the probability to last as long as we will. Now let's talk about 5 market periods when it would have been really easy to move all our money to cash investments to protect against further loss. We define these panicked markets as periods that cause people to say, I just can't take it anymore. The market is down more than 30%. Just get me out. I'm going to hit the panic button because I want to escape the equity markets and avoid losing more money. You may not remember the years, but you probably remember the Middle East oil embargo, when you could only purchase gasoline on alternating days according to whether the last digit on your license plate was even or odd, and the gas lines went around the block. How about the dot-com bubble or Black Monday, when the market dropped more than 20% in one day? The one thing these 5 periods had in common is that the market lost more than 30% during these times. Now let's look at 5 hypothetical investors that went through these 5 panic markets from 1969 to 2019. All 5 of these investors invested $10,000 in 1969. The first investor is the cash investor, the orange line. He buried his $10,000 in the backyard next to his shop down with his fresh water supply, right? I don't want to take any risk and I don't want to be in the markets. I just want to hide it away in safe assets. This investor enjoyed some high interest rates that helped his cash investments. And during the 1980s, short-term interest rates hit 16%. People were getting some pretty good returns on cash back in the 80s. At the end of 2018, the cash investor ended up with $136,000. The second investor we'll discuss is the equity investor, represented by the dark blue mountain area. This investor invested all his money in the markets and he never took it out through any of the ups and downs. He experienced wild volatility throughout this period. But despite the fact that he's in an asylum, He's got the most money of anyone. This investor's $10,000 grew to 1.4 million. The green line represents the bond investor who said, I'll only invest in fixed income or bonds. This investor enjoyed 30 years of falling interest rates, which tend to be very beneficial to bond investors. This investment of $10,000 grew to $351,000. This isn't a bad return. It's represented by the green line. However, with interest rates near historic lows, if asked if you think interest rates are going to continue the downward slide, most would probably say no. That can create challenges for bond investors. The balanced investor, represented by the light blue line, is probably the most prudent approach to investing. This investor said, invest half my money in the stock market and half in the bond market the entire time. This investor didn't enjoy the highest highs or the lowest lows, but they limited some volatility and experienced a smoother ride than the equity investor. They ended up with $907,000. Finally, let's discuss the reactionary investor, represented by the red line. This person is otherwise known as the panic investor. This investor said, I'm an equity investor, but every time the market goes down 30%, I want out, just get me out. I like the markets, but every time we're down 30%, I can't take it anymore. Let me hit the panic button and sit on the sidelines for 2 years, and I'll get back in. These are 5 panic buttons here, and each time we hit one, this investor moved their money to cash for 2 years. Therefore, the maximum amount of time this investor would have been out of the market would have been 10 years out of 50. Look what happened to his return. This investor ended up with $732,000, just about half of what the equity investor ended up with. The investment decisions the reactionary investor made because of fear reveals the missed opportunities that can result by getting out of the market at the wrong time. When we look at the balanced portfolio compared to stocks and bonds, we can see that in most of these down markets, the balanced investor did not drop as much. But we look at this period from 2000 to 2019 and the growth of 100,000, it is really close to the same return for the balanced investor. So again, during different periods of times, you'll have different rates of return, but with the balanced strategy, you had a much smoother ride than the all stock portfolio, and you also did better than the bond investor. Finally, let's discuss our last section, responding to a crisis. When we look at all of these companies on this chart, household names we probably recognize, I'm going to give you a few examples. GE, 1892. In the period from 1878 to 1880, Thomas Edison and his associates worked on at least 3,000 different theories to develop an efficient incandescent lamp. Later, he famously said, genius is 1% inspiration and 99% perspiration. GE was incorporated in 1892, and the Long Depression was a worldwide price and economic recession beginning in 1873 and running through the spring of 1896. The episode was labeled the Great Depression at the time, and it held that designation until the Great Depression of the 1930s. IBM, 1896. The U.S. economy was mired in a prolonged slump in 1896 when Herman Hollerith of Broome County, New York, founded the Tabulating Machine Company, which was later renamed International Business Machines by Thomas Watson, who took control of the company in 1924. Building on its core punch card technology, Watson put the company on a fast track by focusing on landing large-scale custom projects with big business clients. Perhaps just as important, Watson also laid the cultural foundation for the company that has come to be known over the years as Big Blue, a name derived in at least part by Watson's insistence on a dress code, whereas employees wore white dress shirts and blue suits. We can see that there's many stories that took place over different market conditions, and companies continue to evolve over the course of time. While the media may be trumpeting the crisis du jour, chances are there are positive news stories out there that are just not getting much media attention. These exciting future trends could positively impact investors despite their lack of coverage in the media. That's why we call this slide headlines that don't get much attention, because we know that the media will focus on negative stories more than positive trends. MedWand. MedWand puts 10 medical devices in the palm of your hands. For example, it can take your temperature, measure blood oxygen levels, and listen to your heart and lungs. Your doctor can also examine you through a computer, no matter where you are in the world. Ubercopter. The Uber Elevate team is working toward transforming the world through aerial ride sharing at scale. Imagine soaring above congested ground traffic with Uber Air. This future is closer than you think. Uber is developing shared air transportation planned for 2023 between suburbs and cities, and ultimately within cities. The company is working with its Elevate network partners to launch fleets of small electric vertical takeoff and landing aircraft in Dallas, Los Angeles, and Melbourne, Australia, its first international market. Moderna Therapeutics and Vaccines, a name we all probably know now. Moderna was founded on the idea that messenger RNA, the molecule that relays genetic instructions from DNA to the cell's protein-making machinery, could be re-engineered into a versatile set of drugs and vaccines. These strands of instructions could teach our cells to make whatever was needed to treat or prevent disease. Virus-laying antibodies, waste-gobbling enzymes, heart-mending growth factors. AI-powered hand. The Brain Robotics prosthetic hand is the first in its field, an intuitive AI-powered hand that allows the user to make unlimited gestures and grips. Arm and hand amputees may soon have a prosthetic hand that lets them type, shake hands, and use a computer mouse. 3D printed heart. In 2019, the researchers at Tel Aviv University School of Molecular Cell Biology and Biotechnology 3D printed a heart using a patient's cells, providing hope that the technique could be used to heal hearts or re-engineer new ones for transplants. And finally, screen protector that kills germs. New screen protectors from OtterBox and Corning will have EPA registered antimicrobial technology infused into the glass that will keep you and bacteria far away from each other as you text. It kills up to 99.99% of common microbes found on display surfaces. The hot stocks, sectors, and asset classes of the moment, especially those hyped by the media, are what many investors pursue. However, asset classes usually don't remain in the top row very long. And what we're looking at here in this chart is the hot asset class at the top row, followed by the laggards towards the bottom of those vertical columns. As a matter of fact, most of the time, the winners end up going to the bottom of the chart the following year or later. Is anybody brave enough to look at this chart and predict what's going to be the best in any one year? I usually don't get a lot of takers on that because we can't, right? We just cannot predict what's going to be the best next year. And we certainly can't do it based off of what was the best the previous year. So looking at it, ask yourself another question. Does any particular box stick out to anybody when they look at this chart? What about this white area in the middle? It was never at the bottom. That white box is a diversified portfolio. It's an equal percentage of every other box on the chart. So when we talk about long-term success as an investor, you find this diversified portfolio not only provided us long-term returns, but it's done so in a such more consistent fashion where we don't have the angst of trying to pick winners or losers or what's going to be the best asset class moving forward. This may be the most important slide because you can see the average performance over the 30 years of both stock and bond market compared to the returns of individual investors. On average, the equity market shown as the light blue bar returned 9.96, and the bond market shown as the light green bar returned about 5.91%. The average equity investor only had a 5.04% return, and an average fixed investor only 0.38 of 1%. And why is that? It can be caused by our tendency to buy high and sell low. Many investors buy high because they get exuberant about investment categories that are doing really well, and they might load up on those right before they make a downward turn. Or as we saw with our panic investors a few slides ago, they sell low by getting out of the market at the bottom when a recovery is about to begin. And the media news stories influence our tendency to make these kinds of decisions that hurt our long-term result. What's one thing investors can do that might help them stop making decisions that cause them to underperform the market? Don't go it alone. Have a plan or an advocate. To summarize, we discussed stress, anxiety, and crises. Crises all have a life cycle, instinctual behavior, the price of panic, maintaining perspective, and maybe not going it alone and letting our emotions get to us. Acting off of a plan and not our emotions can be a better course of action in the future. How many times does the end of the world as we know it need to arrive before we realize that it's not the end of the world as we know it? Michael Lewis, best-selling author of The Big Short. Next steps, realize America's recovery record. America is 26-0 in these situations. Prior to these crises, there were 26 times we had a market drop of 20% plus in the S&P 500 for 26 different reasons. And the one thing they all have in common, recovery every time. Recovery number 27 may be coming. Of course, it doesn't feel like it, but it never does it? Schedule a call with your advisor, discuss your portfolio asset allocation. Take our risk quiz online. You'll receive a risk quiz link in our follow-up email tomorrow. You can also find it on our homepage at budwealth.com. It is a virtual risk test, second opinion on your situation. And one of the things we talked about today, if you knew how much risk you're comfortable with in the first place, give yourself the best chance of not making a mistake and being penalized like we see in these example slides today. Schedule a complimentary follow-up session to get your questions answered on your own specific situation. The link will be sent in tomorrow's email. You can also schedule phone, video, or in person. You can also schedule it right off of our website at Bud Wealth. For those of you attending that are not clients, as your life unfolds and your goals evolve, our client life process continues to be refined in each of these areas to help assist in reaching client goals. Email us with your mailing address and we'll send you our introductory kit to those who would like to learn more about our firm and our client life process. Thank you again for attending. I hope you found this content of value, and we look forward to hearing from you. You can reach me at jbud@budwealth.com or give us a call with any questions you may have. Thanks again for your time. Have a great rest of the week.